Hi, this is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. Today, I'm excited to talk to you about a company that I do think is potentially unrivaled. We are looking at GLBE or GLBE stock. It IPO just earlier this year. It's already gone up over 100% since its IPO. And as I dig in, I think there is something special about GLBE. We'll talk about it. We'll talk about their value proposition, what's the market they're addressing, as well as their valuation. So the question is, should they belong in part of your investment journey? If you're interested in following my personal investment journey, go to unrivaledinvesting.com. Let's dive in right now to understand what is GLBE and what is the opportunity? What's the problem that they're trying to address? And so first of all, one needs to understand that about 30% of online traffic is from international shoppers. When you're at, you have an e-commerce platform or an e-commerce site, about 30% of it comes from other shoppers. That's the way they framed it. But while you have this huge percentage of online traffic coming from international shoppers, the reality is international sales is a teeny tiny slice of only about 5 to 10% of their sales. So international sales is teeny tiny relative to the number of international shoppers that are interested in global brands. And this creates a huge opportunity. One could argue they think over a $700 billion opportunity in terms of amount of e-commerce that could be going cross-border. And they talk about how cross-border e-commerce is actually growing at 2x the rate of domestic driven e-commerce, the speed in which cross-border e-commerce is growing. And this goes directly to GLBE's mission of making global e-commerce, hence GLBE, border agnostic. So that way you don't really care where you live in the world relative to these brands. It's about making the brands go global, be local. Now, what do they mean by be local? And so it's talking about a localized experience for merchants and shoppers. Both the shoppers, when you're shopping, it feels like the site, the experience, everything about it is custom to where you live, and also makes the job from the merchant perspective also easier. So let's understand what that means. And so this is really the heart and soul of what they're doing, which is that they're enabling companies to go global, such as having local messaging per market across 25 different languages, or accept 100 different local pricing, set things in the appropriate pricing for 100 different types of currencies. Oh, each country might have different types of popularly accepted payment methods. So they have 150 plus payment methods, and it'll prompt whatever is most popular for a given market. Then, well, wait a second, every country has different duties and taxes. Okay, so that's going to be calculated differently in 170 plus markets. Then they have fraud management. That seems to be sort of table stakes that you see. Also creating the functionality of easy local returns. Imagine you're in one country and then you're selling to a different country. How do you make sure you can return the products if you don't want it? And then also dealing with shipping, dealing with many different providers, dozens of different providers out there. So this is about addressing the local pain points that merchants have. And you can think that this must be immensely valuable for any global brand or any brand that wants to go and operate on a global scale. And you can see that they're starting to get clear market acceptance as the gross merchandise value or volume that's going across their platform has increased significantly over time, effectively zero in 2014 to nearly $1 billion in 2020. I think they're going to pass over $1 billion in 2021. So this is clearly impressive what you're seeing in terms of this growth here, in terms of what's gone on with gross merchandise value and doubling effectively year over year. And that's translated into exceptional financials. So they talk about how the overall market is about $736 billion. Most recently, you're looking at $136 million in revenue off of their nearly $1 billion in gross merchandise value. That implies about a high teens take rate, around 17%. So for every dollar that's being spent on their platform, effectively goods that are being transacted on that effectively enabled by GLBE, they get 17 cents. And that is quite a high take rate when you think about it. But they are getting significant revenue growth. But this does include things like that instant messaging, that messaging function like local messaging per market, and helping with customer support and all these, and helping with like payment and shipping. So that there's a lot of fulfillment expenses that go into these sort of this high take rate. So it's not just pure profit margins. And you see that with the fact that their profitability is actually really, really razor thin so far. That said, they are putting up some world-class financial figures, including their 100% plus revenue growth. Net dollar retention is fantastic at 140%. That means net of customers that they've lost, the existing customer base has still expanded by 40%. Even better, in my opinion, is they also talk about their gross dollar retention. You don't often see companies talk about both of these figures. Their gross dollar retention, that effectively shows what if a customer didn't, saying we're not factoring in any of the growth of their existing customer base. And so we're looking at, hey, what customers left versus our existing customer base, giving no benefit of the growth that these customers had, which they clearly did have significant growth of their existing customer base, and saying they had 98% gross dollar retention. That is a fantastic figure since 2018. These are exceptional numbers when you look at it. And it's understandable why these numbers are exceptional, because they're looking at win-win situations, as merchants can see an uplift of up to 60% in increase in sales by tapping into this global market opportunity, tapping into international markets. And one could think, and this is part of the aspect of becoming sort of this global platform, and this is part of the reason why I think they could potentially be unrivaled, is once you start rolling out solutions, oh, we're going to have this market, we're going to offer this country, and they have a bunch of companies that are already operating in that market, that becomes sort of a fluid experience. Oh yeah, we can offer customer support easily there. Oh, we could easily offer payment solutions. Oh, we could easily offer, fulfillment and shipping. And it just becomes, it sort of becomes a network effect, because you're already operating in these segments. Whereas if someone wanted to come along and compete with them, it would be really hard, because you have these companies that want to have a global platform and they don't have access to the 100+ countries that they are already enabling right now. And that is a strong advantage when you think about this type of business, in terms of saying, hey, day one, if you want to figure out how to roll out globally, we can help you do that. Very powerful, and get stronger over time because they build out that local knowledge. That strikes me as quite impressive. And so here it is. What's super interesting is that they're effectively leveraging their partnership with Shopify. They do have an agreement there, and that's part of the reason why they've been able to spend so little on marketing, about 7% of their revenue on marketing, and that's part of the reason why they've been profitable and still put up these monster growth figures, is they're leveraging the Shopify platform, which a lot of e-commerce is currently doing. And effectively, Shopify says, hey, we really like what you're doing, enabling this global e-commerce. We like it so much, we want to create this sort of agreement with you, but we also want to own some of your shares. So right now, Shopify itself is effectively buying in here and owns about 5% of the company, about 1/20th of the company. So that is interesting to see that partnership. And the tricky part is with all these companies is you see an exceptional company, you see a potentially unrivaled company, and you want to know, like, what's the fair price? What's a reasonable price to pay? And before talking about that valuation, I'm going to do just a quick plug, where if this is your first time tuning in, you like learning about potential multi-baggers, types of stocks that could potentially go up hundreds or even thousands of percent over time, make a point of subscribing to this channel. If you're already a subscriber, I do appreciate that thumbs up. If you want to follow my personal journey as I buy stocks that I hope to be potential multi-baggers, go to unrivaledinvesting.com. Once a month, I call out a stock that I believe has asymmetric risk reward, the type of upside where I'm saying, hey, this potentially has hundreds of percent upside over time, and maybe the downside is much more reasonable. And I also, the first week of the month, I call it my full portfolio. You also get weekly updates. What am I buying and selling? We're also building an exclusive dedicated community on Discord. Learn more about it at unrivaledinvesting.com. Let's dig more into GLBE, particularly understanding GLBE stock, particularly trying to understand what is their valuation. So how should we think about their valuation? And as we look at it, it is a very low gross margin business. Right now it's between 20 and 30%. But critically, this gross margin has expanded very significantly over the last 2 years, from 22% gross margins to 32% margins. So that makes me start wondering, well, wait a second, what does this gross margin look like at maturity? This means this business is not at scale yet. This business needs to scale, but critically, they did reach a profitable level in 2020. That is something the market certainly loves to see, because when you are profitable, it means you don't have to dilute shareholders nearly as much with potential future equity raises. So this is very interesting to see that they've already sort of reached scale. And the fact that they're able to grow at 100% with only spending 7% on sales and marketing, that is part of leveraging the Shopify platform. It's just super interesting to see how these expenses, and suspect how these expenses can get leveraged over time. But I think in order for this business really to get to scale in terms of their true economics over time, it's going to be about raising this gross profit margin figure. And this is a service and fulfillment driven business. As service fees, think of it as the commissions on the gross merchandise value or the volume that's going across their platform increases, and they're getting a high margin cut. The service fee is much higher margin than their fulfillment fees. It increases their gross margin profile, and that's what you see has gone on here. So I think over time this gross margin profile might just be able to get up to, and this is a guesstimate, that at scale maybe you're talking about 60%, maybe you're talking about 50, maybe somewhere between 50 and 70% gross margin. So that is what I'm thinking longer term based on looking at their current service fee margins. That said, management hasn't penciled out, hasn't called it out clearly what they think their long-term margins look like, at least per the prospectus. So this does take a little bit of educated guesswork to think about it. But you look at their projections for this next year, they're talking about continued hyper growth and fundamentally core profitability with positive adjusted EBITDA, where they're guiding to 55% revenue growth and 8% EBITDA margins. This is, head and shoulders way better than most companies you're looking at today in terms of valuations, in terms of profit margins, being able to talk to profitability, being able to talk about this exceptional growth. And so how does this pencil out to getting an appropriate valuation? That's the question. Is let's start plugging these into a hypothetical valuation framework, and what's the end result? And as we look at it here, it's currently, once again, the stock's up meaningfully since its IPO. It's currently around $8 billion valuation. And, they, based on their guidance, they're effectively penciling out 55%. I'm saying, hey, maybe they're being conservative. Let's put a 60 to 80% growth range for this next year. And that might be too high on this high side. Assume long-term margins of, let's say, 15 to 25%. That's, once again, this is super tricky. This is very, very far into the future, because keep in mind, they're only at 30% margins, gross margins right now. They're only at around 6% operating margins right now. So this requires multiples higher in terms of what their profitability could look like in the future. Slap on, let's say, 25% tax rate. You're talking about a company that's on an optimized earnings basis is trading effectively somewhere between like 200 and 300 times, which is quite rich, and 30 to 35 times sales. Super rich types of valuation. That said, the question is, what's their growth rate in the ensuing 4 years? I'm penciling out maybe 50 to 60% on an annualized basis. This could be wrong. This might be too high. This might be too low. And this is part of the reason I'd love to hear your feedback in the comments below. If you think, it should be way higher, way lower, I'd love to hear your thoughts on why, as we're both learning about this setup in GLBE. So setup, assume some sort of end multiple 5 years out. 5 years out, what's the appropriate multiple on an earnings multiple for this? I'm saying 30 to 40 times, because keep in mind, 5 years out, the growth rate should be slower. This is a much bigger company. As you get bigger, it's harder to grow at a faster rate. Generally, you don't see acceleration as a company grows. You see steady deceleration. And so looking at this 30 to 40 times sort of gets you to pretty lousy risk reward, in my opinion, where you're effectively penciling out 50% upside and 50% downside. So I just think at this point, you've seen a dramatic run in GLBE stock, going from effectively this IPO price of 25 bucks a share to around 55 bucks a share. This strikes me as super rich. In order to get a even better return, I think what you'd need to see is really far exceeding their guidance and penciling out exceptional growth in the years ahead that suggests very little deceleration. That is a tough one to pencil out. I think, I think this is, in my opinion, just not a super attractive risk reward. I think there are better plays out there. I occasionally call those types of situations out, here, on YouTube, but for the most part, I save a lot of that for my exclusive, subscribers at UNRIVALEDinvesting.com, my Journey subscribers, where, once a month calling out a potential multi-bagger. In the last couple of months, I called out a stock that's trading below liquidation value, that's growing nicely, and that ultimately I think could be up 2 to 3x over time. So that's the type of setup that I personally want to be putting my capital into, where it's like, hey, I got this liquidation value, and it's trading well below liquidation value. That covers my downside in my mind, and then the upside is like, hey, things start working out, and the company keeps growing. So like that's what I'm personally looking for. If you're interested in hearing more about those types of plays, go to unrivaledinvesting.com. If you found this video on GLBE to be helpful, heck, this strikes me as a super interesting company, strikes me as potentially unrivaled. The valuation is just it's a little too spicy for me. So if this has been helpful for you, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.